We have Nick Legamaro on the call. And Nick, I really appreciate your time. But Nick is known as the note guy, and we're going to delve into this. And in fact, we've only spoken to a couple other people regarding this topic, but I always find it fascinating how this works. And in fact, I've tried it a couple of times myself just to turn around a pretty dog of a rental unit or two. And it really is kind of an eye-opening experience how actually it's a lot easier than people think it is. But what can be accomplished with this strategy. So I really appreciate your help, Nick, but I'm going to point people right off the bat. You can follow along and find more resources and information at usanotepro.com.
That's it.
So really appreciate it, Nick.
Check it out. Awesome.
So, I'm always fascinated. Like, how did you find your way to carrying paper like this?
Well, let's just say I got lucky at the end of the day. I mean, long story short, and I've told this story on numerous times, and I don't want to get into the long version of it. Basically, I had a property that I was able to acquire that had some debt on it, and I didn't have. I knew it was worth more than I was going to pay for it. I didn't think I could sell it for cash for what it was. It was a cheap house back. This is 15 years ago in Dallas, Texas, when there was houses you could get for that were worth $50,000. Now that same house is 2 or 3 times that amount. It doesn't exist any longer. But the seller wanted $25,000 because that's what she owed on the property. And I knew it was worth more than that. I didn't think this was when I was really getting into wholesaling, just starting out. And I thought it was worth about $50,000. And I had a buyer somebody that helped me. And I said, do you think if you have somebody that's got $25,000 down payment and I will finance the rest? And instead of what I probably should have done is I said, hey, do you know somebody that's got $50,000 cash? I got a great deal, and taking that transactional cash from the property and put it in my pocket like most wholesalers do, right? Mm-hmm. Something just clicked at me at the time to say, well, I don't need all that cash now. I didn't think at the time somebody really had $50,000 cash. And so that's what I did. I got $25,000 down. I financed. I think the net number was like $22,000 on that. I paid off the seller, paid a little bit of a fee to the person that brought me the deal, and I wrote my first note. And then from there, it just has evolved into, I've done over 700 plus. I stopped counting at 700 creative financing structured deals. I built a whole business around and actually sold the business to a bank back in 2018. So I might not be the biggest and the most knowledgeable in the space, but I think that I've done enough to really understand what's the value proposition for me. And that's what we talk about today, is really talk about how to be the bank, right? Because ultimately that's what this is about. And for me, being the bank is about control, not owning, right? You talked about having rental properties where you were the landlord. Well, where you're the landlord in a tenant landlord relationship, I'm the bank, I'm the lien lord, right? I call it the lien lord. I control the property through the lien. And that's what I choose to do. Because at the end of the day, you go to any city in America and you go downtown and you look up, they're all names of banks on the top of the buildings. They're not anybody else's names, but pretty much banks and insurance companies. And I learned a long time ago, if it was good enough for the bank, it's probably good enough for most investors. And that's sort of the model I follow, and I love it. It's about as passive of an investment strategy that I know of. And once you figure out and sort of crack the code and really be able to put a system and a process around it, it's really quite enjoyable, to say the least, not to have to deal with tenants any longer. Not that was never really my model, but I've heard stories, to say the least.
Yeah, well, no, what makes this appealing, especially with some single family homes, I mean, to be frank, unless you're buying a newer property that's been updated and repaired and ready to go, it just takes the refrigerator going out or some small thing, and it destroys your cash flow for a year or more.
Yeah, I mean, people
So
can
you,
make the argument about depreciation. Well, and depreciation is nice, and everybody can use some level of depreciation. But I just say treat it like a portfolio, an investment portfolio. Don't put all your eggs in one basket. Don't put them all in the fix and flip basket. Don't put them all in the wholesaling basket. Don't put them all in the cash flow from a rental perspective basket, because you need a little bit of everything really to really put together the best return on your investment of energy, time, and effort, in my opinion. And that's sort of what we do.
yeah, well, you're basically saying real estate diversification. We've heard that diversification from growing up, just in a
But
different format.
it's funny how few people actually do it in the real estate space. It's really quite amazing. Either you focus just on wholesaling, or you only want to do the BRRRR model or method, or you're only going to be, you know, a
Yeah.
buy and hold investor. I mean, those are all great strategies, and you can make money doing any and all of those. At the end of the day, for me, especially in where we are in today's economy, what we're coming through, the uncertainty of the future, I like dealing in known quantities, okay, as much as I possibly can, especially if I'm dealing with my own capital or if I'm using somebody else's money. I want to get in and get out of the deal as soon as I possibly can, take the money and run and figure out how to take that profit that I get. And then I might become a little bit more, um, uh, less conservative with the investment strategy. Might get into something a little bit more speculative, but that's only because I've already made that money. Not that I'm jeopardizing my capital stack to make something else happen. I think that's a dangerous proposition.
Well, if you don't mind, like I said, a lot of this is going to be relatively new to most of my listeners here. Could we take a moment and just kind of walk through how this process works, from like identifying the property, how you set up the creative financing, how you sell the note or the paper to a buyer? Like, how does that all look?
Yeah. So really, and we can get deals a lot of different ways, but the ways that I see most of this happening is the deal can either come from a wholesaler. So if you're a wholesaler, that's one way that this deal could manifest. Or if you're a landlord, a tired landlord, that's another way. So they're both a little bit different in themselves, but you always got to start with the deal. So I talk to wholesalers all the time, and I educate them on, the model is very simple in a wholesaler's mind, right? You're going to go buy a property and put it under or you're going to maybe not even buy it. You're going to put it under contract for X. You're going to add a fee, and you're going to sell it for Y, right?
Mhm.
And depending on what formula you use, let's just use a maximum allowable offer of 80%, right? So if your maximum allowable offer is 80%, and it's $150,000 value, well, then you're going to get that for $120,000, right? That's your maximum allowable offer. That's including your repairs and uh, cost of capital and whatever that makes it up. So the
Right.
question always becomes, and I always ask the question, what happens when you have a seller that needs $130,000 total? So maybe you take out the repairs, but they need more than what you're willing to pay because it's outside of your maximum allowable offer. Say there's no repairs needed, okay? Because math is much simpler this way.
Mhm.
So you're at 120 and they need 130. So how do you make that deal work if you're a wholesaler? The math doesn't work, because it's very rarely you're ever going to have a seller come to the table and write a check for $10,000 to take their house off their hands. It used to happen back in the day when there were short sales, but those days are all over. So you got to be able to figure out how to get to that seller's asking price, right? So by knowing that you can pay a little bit more for that property because you're going to exit out of it differently than a fix and flip model, it just opens up the opportunity to get more deals. So let's just be a little bit more specific in the example. What we do is, so we take this property down, and most of the stuff I'm doing right now is more because of the way the market is right now. We're doing a lot less construction and remodeling than we have in the last 15 years. Okay. because buyers are the sell. It's a seller's market, and buyers are such in need of properties. They're willing to take deals or to buy properties that don't need, that aren't completely remodeled and upgraded. They're perfectly livable. You know, they still got grandma's 1970 kitchen in it, but they're willing to buy it today and leave grandma's, you know, avocado green kitchen in there, and knowing that they can own that house, and then they'll figure out a way to make that, the remodel that kitchen. We're seeing a lot of that right now. Beggars can't be choosers, and there's a lot of buyers that are begging to buy the house. So what we do is we just model this out. And what I do is I write, depending on how you can acquire it many different ways. You can acquire it with cash, you can acquire it with hard money, private capital, or you can even buy it from the seller with terms, right? Sometimes the owners own it free and clear. These are all ways that you can take it down. What we do though, is that when we exit out of it, instead of selling it to a retail buyer like a traditional fix and flip model would, we sell it on seller financing. We sell it on terms. Okay, so we go find an owner finance buyer. And we're not going to get into the weeds on all the Dodd-Frank and SAFE Act, because all that can be underwritten through an RMLO, which is a residential mortgage loan originator. They're in a lot of different states, and it's just an outsource, right? So know that they're available to work on your behalf. And then I write a first and a second lien. So let's just take a $200,000 property. I just did one. I don't know if I have my sheet here handy. I know, but I know the numbers. So at $200,000. So I write so what I do, I write a 75% first, which in this case would be $150,000. And then I get 10% down. So that's $20,000, right? And then I have a second lien of $30,000. So 150 for the first, 30 for the second, 10 and 20 for the down, adds up to $200,000, which is the sales price. So that $150,000 lien that's in a first, that's written at a 75% loan to value, I can sell that loan immediately, that lien immediately, that note, to a note buyer, and I can get, let's just say I get 145 for it. I got to discount a little bit because it's not seasoned, but my cost basis on that deal is, let's say it's 150. Okay. So I sold it for 145, but I owed 150 because that's what I borrowed to do the deal. So, but I got $20,000 in cash down payment from the buyer, right? So the net effect of that transaction is actually the debt is gone because I paid off the debt. The first lien is gone because I sold it to a note buyer. And the profit on that deal for me in this model is a $15,000 in cash transactionally, which is more than a wholesale deal most of the time these days. And then I also got a free and clear $30,000 second lien at like 10.5% interest amortized over 30 years. And that value of that note's close to almost $100,000 in perpetuity. And that's the model that I do. But what did I actually gain out of this? And this is the important thing I think we need to explain, is that I had to do a little bit more work to get to that point, but I'm getting paid for a longer period of time. But I have zero risk because all my cost basis is wiped out. I paid off all my debt. I got some cash today, right? Even $15,000 is not a lot of money, but it's not a little money. I mean, when you do it on a $200,000 house, I'm going to get cash flow. So $30,000 cash flow at a 10.5% interest is probably $260 a month cash flow. I'm going to get that in perpetuity for up to 30 years on the term. And then I'm also going to get the payout. So even though I wrote that note for 30 years, the likelihood that note performs for 30 years is highly unlikely. What will usually happen is somebody will sell, or they'll end up refinancing, or some other event will happen. And let's just say that's 10 years from now. Okay. So I'll say I make $250 a month for the next 10 years. Okay. So, and I'm just winging these numbers. I don't have my financial calculator in front of me. Well, let's just say it's $250 a month times 120 months. That's another $30,000 in cash flow. Okay. But if you look at an amortization table at that, depending on what the interest rate was, the payoff is probably still going to be about another $23,000 to $25,000, might even be a little more. So then when they call the bank, well, who's the bank? Well, I'm the bank because I'm the one holding that second lien note. They're going to ask for a payoff. I'm going to run the amortization table. I'm going to give them the payoff. And then when they refinance or sell that house, I'm going to get another check for another, call it $25,000. So that one transaction gave me $15,000 cash today, transactional. It gave me $30,000 in cash flow at $250 a month over 10 years. And it gives me another lump sum payout at some point in the future, somewhere in the $25,000 range.
Sure.
So that's the quick version of it.
Well, that's a heck of an elevator pitch. I tell you that,
well, I don't even tell an elevator pitch, man. So, but it's not as hard to do. Here's what I'll say. It's not that hard to do if you understand what the components of the deal are. The beauty of the model, in my opinion, is that you don't have to do any of this yourself, right? There's a third-party RMLO that will do the underwriting for the borrower, right? There's a servicing company that will service that note and collect all the payments and escrow the taxes and insurance and put the money into your account. Think of it like a property manager, right? So we're not even dealing with the borrower at any point in time. So let me ask you a question. Have you ever had a mortgage on a house? Have you ever on a mortgage? Okay. I don't care who it was with. I just had mine with Bank of America. I just paid it off after 20 years. I finally got it paid off. Have you ever called the bank for anything relative to your house that you had the mortgage on?
No. And I actually would find it silly to do so.
Absolutely. It's a different mentality, right? Now, if you were a landlord, you would expect calls from tenants, right? But if you're the bank, you don't expect calls from owners because they're the owner of the property. It's their responsibility to take care of the leaky roof or to fix the foundation if it cracks or, replace the HVAC system if it goes out, right? That's their responsibility. Their other responsibility as the owner of the property is to pay you, the bank, whatever the agreed upon payment is on time every month. And if they don't, you have the right to get it back because that was the agreement. That's the beauty of notes. It's a securitized investment. It's secured by the actual property. You can't get that anywhere else. You go buy Amazon stock or Tesla stock. I use these examples all the time. Great stocks. If they go down 20% in value, either one of is Elon or Bezos going to say, "Oh, I'm sorry. I'll make up the difference to you." It's never going to happen, right? But you have the house as collateral. So even if the borrower stops paying and you're in a position to leverage that, you're going to get paid. Banks always get paid. I don't want to say it again. Banks always get paid. They might not get paid today. They might not get paid tomorrow. They might not get paid for 6 months, but they will get paid because they have the house as collateral. Whereas if you're a landlord and you have tenants, that is not always going to be the case. And I think we learned that in the last year and a half of COVID. There's a lot of landlords out there that are going, "Oh my goodness, I'm never going to get my money," because these tenants have, to some extent, have taken advantage of the system, and they'll never be able to recover it because there's no financial liability or responsibility to the borrower or the tenant to pay the landlord. Now, can the landlord go get a judgment on it? Absolutely, but it doesn't mean they're going to get paid on it. And that's the fundamental difference. That's why I like being the bank versus being a landlord, but to each their own.
So how long does this process typically take where you acquire the property, you get the note, you sell the note, and you carry the second back? How long is typically, you even mentioned at one point, your notes are typically not seasoned, so you end up selling them for a slight discount.
Yeah. So, cause it's all about velocity for me. And, the answer is it depends. And it depends on what you do to the house. So think of it like two separate transactions. The first transaction is the buying and the fixing it. Maybe you don't have to fix it. Maybe you do. And then how would you normally exit out of that first transaction? You would either maybe keep it and refinance it and make it a buy and hold and a rental property. You might turn around and sell it retail for a profit. And what we're doing is we're doing up to that point, it's pretty much the same. The difference is that we're going to go to a buyer that needs financing versus somebody that needs seller financing versus somebody that can qualify for a traditional loan. So that whole process. So you can make that first part of the process as long or short as you want. Most of the stuff we're doing right now, we're not even fixing houses. We're just setting the price at the value that we see that the market will dictate to set that exit. And so these properties now we're doing very minimal construction. Some houses we've done full gut jobs, but right now we're trying to avoid that because it just isn't needed. And even though you might make the same amount of money by doing that, maybe you make a little bit more by doing the fix and flip. The problem is velocity. And what I mean by velocity is that I can get in and out of these deals in weeks if I don't do the construction versus months if I do. And when you take that same capital stack and you have the ability to reinvest it deal after deal after deal, if I'm doing construction, I might only get 4 turns a year with that capital if I'm lucky, right? But if I'm not doing anything, I might get 8 or 10. So even if I make a little bit less money, I'm going to monetize the whole process. I'm going to get more money gross over the time with a lot less headache and a lot less physical work by doing it. So to answer your question, it depends on the front side, but from the note side. So when we get a buyer, as soon as we put that property up for sale, we're gonna get buyers that are extremely interested in the property. Because here's the reason why. The last numbers, and it depends on where your data sources come from, but it's somewhere in the 60 to 70% number of the general population that would go apply for a traditional bank loan would get denied or declined. Okay, that's a huge number. Okay, so if you're telling me that only 30% of the population can go down to the bank and get a loan to buy the property, hey, rates are historically low right now. They're 2.5%, 3%, whatever they are. Well, that's great if you can get it, right? But we know for a fact that the majority of the population can't get it. So where do they go? So what do they end up doing? Well, they can only do one of two things. They either got to find a seller that's willing to carry financing, or they don't buy. They have to be they're stuck in the rental pool. And we also know that 80% of renters rent because they have to, not because they want to. So when you look at economics 101 and the supply and demand of all this, it's much better to be on the side of that where your property products in demand, not the other way around. And it's really hard to see that right now because it's such a seller's market. But most real estate people that are in this space, you're on both sides of the fence anyway, right? I'm a buyer before I'm a seller, and then I'm a buyer again, then I'm a seller. So the landscape of real estate right now, it's indifferent to me whether it's a buyer or seller's market because I'm both at the end of the day. I prefer it actually in my model for it to be a buyer's market, not a seller's, because I have a lot less competition when I'm buying. If it's a buyer's model, I'll actually make as well as we do in a seller's market. We'll actually do much better when the market switches to buyers because that 70% is not going to go away. So,
sure. So you mentioned that you have this underwriting team that's handling the underwriting portion to you. Like, how much say do you have in that? Do you tell them like what's your requirements and they just stick to it, or is it just kind of
so we still follow? So what happens, and I don't want to get into too much of the details on it. When Dodd-Frank was established and SAFE Act and all that stuff, they wrote these rules and guidelines that that if you're going to sell a property, now if you're only doing one or two of these, you don't need to use an RMLO or follow Dodd-Frank or service a note or any of that stuff. We just choose to do it. We're required to do it because we do more than the minimum requirement. But even if I was only doing one or you were only going to do one, I would still recommend doing it because it establishes best business practices. And it's really what you want, because that underwriting file that's created is a big factor in determining the value of the note when you go to sell it. And since we're selling this right away, we don't have the performance history of the note on our side to fall back on. So we have to fall back on the underwriting in the property itself. So look at it this way for a second. Say, and I use this, I'm in Texas, so I use the Ford F-150 example, right? It's a truck, right? And you have two trucks and they're both 2015 builds. They're both white. They both have the same 50,000 miles on them. And on the surface, they appear to be the same. However, one truck has never had maintenance done on it. It's been beat to crap. The kids have drawn all over the back seat with pen. It's never been maintained. And the other one, same truck, same miles, but it's in pristine condition. All the service records are impeccable. and it's only one person's been in that truck the whole time. No one's ever sat in the back seat, and so on. That you understand the value on those two trucks is entirely different based on the condition.
Mhm.
Well, notes are no different. The condition of the note is the same. So the underwriting file is important. You know, did you take an application when you sold it to the borrower, or did you not? Did you verify who they say they were, or did you not? Are you servicing the note or are you collecting cash payments? All those factors and all those conditions help establish the risk of that note, right? Because when you sell a note, you're selling it based on the value, the return, but more importantly, the risk that's associated with that note based on who the borrower is, where the property is located, and so on. So those are all integral parts of determining the true value of the note. And now once you have servicing in place and the note's been performing for a long period of time, a lot of that stuff goes away, because really then the performance is the true indicator in most note buyers' eyes on really what the value is. So that's really the reason why we do it. But if you're going to stay in the deal long term, like we are, and you're going to hold that second note, even though there's no cost basis to it, I want the note to be written as best as possible, because that's my cash flow and that's my investment that I'm getting the most my return on.
Mhm. No, this is, like I said, this is really interesting. So if people headed over to your website, that usanotepro.com, would they find some of these
Yeah,
resources?
so
Like,
actually there's a couple of ebooks on there, and it talks about selling notes, okay? So because we buy notes all the time, and we want to educate people, if they're going to sell a note, what they need to have in place. And it talks about these same things, but just think of it on a different, through a different lens, is that if you're selling a note, then you understand what the buyer wants. Well, if you're buying the note, then you understand what the seller needs to provide. So even though it's written from a seller's perspective, it's it's no different if you're the buyer. Just change the interpretation of the information from a buyer's perspective. It says you should have the file stacked. Well, if you're a buyer, then guess what you should be doing? You should make sure that the file is stacked with all that data that you'd want, or you're not gonna buy it for that price. And if you're gonna sell at the same difference. So yeah, there's some stuff out there. There's some other videos and some other things like that. I think at the end of the day, it's just you really just need to understand that there's another way to monetize deals where other people that have said it can't be done. We work with wholesalers all the time, and I have these conversations, and I was just presenting a week or so ago, and I was talking to a wholesaler, and he was pretty proud of himself. And I asked him, I go, what is your conversion rate? Like, how many deals do you get? Like, from all the motivated sellers? He goes, we get about 20%. I go, that's pretty impressive, because I used to wholesale
mhm,
and I never was at 20%. You
no.
know, and I think in this marketplace, if you're somewhere between 8 and 12, it's a pretty good thing. So I asked him, I go, 20%, that's pretty high. That's pretty high. And he was pretty proud of himself. I go, good. So how many deals did you do last year? He goes, we did about 100. I did the math in my head real quick. I go, if you did 100 deals and you got 20% of them, that must mean that you had 500 sellers. He goes, yeah, we were pretty busy. We got about 7 or 8 acquisition guys. We're hustling out there. I go, that's great. And I go, well, what happened to the other 400 deals? He goes, what do you mean? What happened to the other 400 deals? I go, where are they? He goes, well, we didn't get them. I go, why didn't you get them? He goes, we didn't get them because the seller didn't accept our cash offer. I said, well, that's your problem. Okay. What if you were able to accept the seller's asking price versus having the seller accept your cash offer? See the difference? And
Mhm.
so, and we can do that. And when you have this strategy in mind, you can leverage the underlying debt. You can pay a little bit more because you're going to get paid in time in the back end. At the end of the day, sometimes we make cash. So let me ask you a question. If you can make, if it cost you, and I'm not saying you would do this, but you should do this. I'm just asking the question, because there's a different line in the sand for everybody. If I told you you can make $250 a month for 30 years, okay, and the
Mhm.
interest rate is 10.5%, and it's amortized, and you would get a lump sum payoff if they ever pay that off early, whatever the balance is. How much cash would you put into that deal? Would you put $500 to make $250 a month?
Oh yeah.
Of course you would.
Yeah.
Would you put $3,000 of cash into doing it?
Yeah.
Probably would if you had $3,000 cash. At some point you say no, no mas, right? You say no more. It's not worth me doing it. See, and that's the question that you get asked. So even though the example I showed you, I actually netted $15,000, but I very easily could have paid $5,000 and done the same thing. And I would have got, if I would have let's say I take $5,000. I'm just using that as a round number. I divide that by 250. That's 20 months. So it's a little less than 2 years. So if I would invest, so am I willing to invest $5,000, get all my money back in 20 months, and then have the remaining 340 payments of 250 come in free and clear? Sounds like it's a pretty good investment to me. Oh, by the way, I have the property as collateral in the event that the borrower decides not to pay me. I can foreclose. I can go get cash for keys. I can get a deed in lieu. There's a lot of things I can do to protect my investment. So that's a question that you have that you can ask yourself. So where I'm going with this is on that deal. I could have, in theory, if I was willing to pay $5,000 for that, in theory, I could have paid an additional $20,000 to acquire that property. Correct?
Mm-hmm. Yeah.
If I made 15 doing the deal that I did, and I would be willing to pay 5, then in theory, I could have paid $20,000 more. Well, that's exactly how you get some of these deals in that above that 20% mark, is because you just pay a little bit more because you're going to get it back out on the back end, you asked the time frame on it. Most of the stuff that I'm using in and out of it between 30 and 45 days. That's my number. Now, if I'm doing a heavy rehab, it's going to take longer, but I'm going to find that buyer. I'm going to find a buyer usually within 3 to 5 days, and I'm going to be able to take them and get them underwritten in about 10 days. And then I'm going to cash out of that about another week after that when I sell the note. Because what I'm going to do is I'm running them concurrently. I'm selling and shopping that note based on what I know the borrower file looks like. And I've already have the buyer already lined up before I even get to that point.
Well, it seems like we almost need a part 2, because there's a whole discussion here regarding identifying that buyer, and
so I'll say a couple things on that, because I think because it's always the fear of the unknown, right?
Mm-hmm.
And if you don't know that you can actually go get a buyer, so how am I going to go find an owner finance buyer? How am I going to get them to pay me 9.5% or 10% for my mortgage? Well, you don't, unless somebody that's already done it, and you have a proven track record that can show, all these transactions. But here's a really simple test. If you're a landlord or you have a house, just go post it on Facebook Marketplace and say seller financing available to well-qualified borrow with down payment, and be prepared for your messenger to blow up, your email to blow up, your phone to blow up, because the number of people, we already talked about it, 70% can't qualify through a traditional means. So that means 70%, if they want to be a buyer, may have to use some other source to get the deal done. The buyers are there. That's not the problem. The buyers are not the problem. The other thing is that what people fail to understand is how big the seller carry market is. Okay. And when I mean by seller carry, I'm talking about seller financing of businesses, single family homes, land, whatever, that aren't financed through Chase, Wells Fargo, Bank of America, the big traditional lenders. Okay. And that number is about $25 billion a year. That's billion with the B. Okay. That's not a small amount. So there's a lot of people out there that create financing, and that know that they can do that. But more importantly, there's a lot of people. You ask 100 people that they know they can create their own seller financing and carry the note and be the bank. 99 out of 100 are going to say no, and it's probably even less than that. To be quite honest with you, they just don't know that they can do it. So it's just not amount that they can do it. The other thing people don't know, they can just go buy notes. A lot of people don't know they can even go buy mortgage notes from companies like us or on the market. Just like you go buy a house and you'd pay cash for it in a wholesaler. You can go buy notes just the same, but people don't even understand that because they don't even know that that even exists. So there's plenty of ways that you can materially participate in the note side, either by buying them from a broker or directly from a seller or creating them yourself.
Well, before I let you go, there was just so much information
I
here,
know
but
it's crazy. I don't even
I
know.
and like I said, we could easily do a part two because there's I'm just scratching the tip of the iceberg of the number of questions I actually have for you. But I always like leaving people with like one actionable item. So if they were looking to get into this, what would you suggest would be the first thing they do to
Yeah, so I think the question would be is if they're a if they're a landlord, then they can look at it if they want to. If they're a landlord and they're trying to decide if they want to continue to be a landlord instead of selling that property, is maybe turn it into an owner finance deal. That would be one thing. That would be I would at least exercise that um, possibility. But
Mhm.
if you're a real estate investor and you're a wholesaler and and you're not able to get all those deals done, go back to the seller and ask them this a very simple question. And I'll use the example that I already said. I'm at $120,000 on my offer. You need 130. If I was able to come up to your price, would you be willing to maybe take some cash now and some later? Or would you be interested in entertaining a creative deal financing structure? And leave it at that. Because if we can utilize that debt that's already in place and you can eliminate the need of going borrowing, you can pay a little bit more for it. And then it's just going on and creating the deal. So, they can always go to USA No Pro if they have a deal that's questionable. They can submit it through the, there's a, um, to the wholesaler helper link. There's a link that they can put in and put some deal information in there. And we'd be happy to look at them. And we even buy those dead leads. So if they're dead to them, we'll come in and we know we can structure a deal creatively. We'll pay them a fee for it, and they don't even have to even materially participate in the actual deal, but they can get paid on deals that they thought were dead and make additional money and help offset some of their cost and overhead. So just education is the biggest thing, is like just understand that there's more than one way to do a real estate transaction. And depending on where you are in your real estate career, you don't have to do any of this your own. There's plenty of people that you can partner with that will help you do it and split the deal. For me, it's all about collaboration, not competition. And I'm a firm believer in collaboration, because at the end of the day, the ocean is massive. The ocean is massive, and there's plenty in the ocean for everybody. And I don't need to be I don't need to control it all, nor do I want to control it all. And I thoroughly enjoy helping people get deals done where they thought they couldn't get them done and get paid on them, and go from there. So I hope that answers your question.
Yeah, no, that does. And, I think if anything got people's attention is that little example that you provided where you were getting about $250 a month for 30 years. That should be a standout because typically, especially for a single family home, I think a lot of people are seeing $250, $300 a month as net rental income.
That's true. With all the
It's
risk.
there's not much difference there, and the big difference there is you're removing yourself having to be the landlord.
Absolutely. And the risk and the liability and a bunch of other things. And, and not all deals are the same. Not all markets are the same. And you just have to model it out. And we actually have a calculator. And if they go to the USA No Pro, I think it's on there. And if not, they can ask for it. And, it's a little modeling calculator. I know there's some videos on there on how to put the numbers in and see what the outcome is going to be. But the key to this model, I can't say this enough, is you have to structure the deal correctly from the beginning to get the maximum return on that note. And the way that you do that is by underwriting the borrower, which is done through a RMLO, and by servicing the note, and then finding the note buyer that it will pay you the appropriate amount for that note. And we can
So,
help with all three of those.
well, I appreciate it. This was just a great conversation, Nick. I want to point everybody again to your website, usanotepro.com. You can find a ton of information and resources there. But you're always welcome back. Would love to chat with you
Hey,
again sometime.
and the other cool thing that we started doing, and I think it'll be on the website as well. It's called, we do once or twice a week, we do a live online. It's called Deal or No Deal. And we take these deals that people bring into us and we look at them and say, okay, is this a deal or no deal from a creative structuring standpoint, not whether they should buy it as a wholesale or a fix and flip, because I could care less about that, quite honest with you. We want to know if the deal works creatively and how we would structure, like how would you take the property down? Would you fix it or would you not fix it? And how would you exit out of it? And what would you do it? And how do you, what's the economic impact on doing the deal? How much cash can you make today? How much cash flow can you make for how long, and what's the lump sum payout? And we do that. And people submit the deals based on some of the criteria we ask, and we go through them live, and sometimes they're deals and sometimes they're not. But usually we can figure out a way to make it a deal, and make it work, if we get cooperation from the sellers. The sellers is ultimately the bottom line.
Right. No, that I when first starting real estate investing, that was the number one way to learn, was to actually see examples and go through an actual example.
And I learn a lot by doing it, because sometimes questions come up I don't know the answer to, and I don't know everything. I'm never going to say I'm going to, and it forces me to go out and find the answer to the question. And I come back and I do it. So it helps by interacting and doing these kind of examples. It really helps expand my learning and my knowledge base as well, which inevitably helps other people out as well.
Yeah. Well, Nick, this is again great. Head over to USA Pro, notepro.com, notepro.com, usanotepro.com.
USA Pro might be something that nobody wants to go visit. I have
no,
not me.
I appreciate that correction.
All right, man.
I appreciate it. Thank you, sir.
All right, JD. Thank you.